Right now, imagine you just got an unexpected $1,000. Maybe it's a bonus, maybe it's a tax refund, maybe someone finally paid you back. Your first instinct is probably already forming a new phone case, a weekend trip, maybe just paying down a little bit of that credit card. But here's what almost nobody tells you about that moment. The way you handle that first $1,000 says more about your financial future than almost any other decision you'll make this year. Not because of the money itself. $1,000 won't make you rich. It won't make you poor either. It's because of what that money reveals and what it sets in motion. Let's start with what most people do. Most people treat unexpected money as extra, not real money. Found money, money that doesn't count the same way their paycheck counts. Behavioral economists call this mental accounting. The idea pioneered by economist Richard Thaler is that your brain doesn't treat all money the same. Even though a dollar is a dollar from your paycheck feels serious. A dollar from a refund feels like it's already half spent. So when $1,000 lands in your account from somewhere unexpected, your brain quietly files it under fund money. And fund money gets spent differently, faster, looser, with less guilt. This is why lottery winners, bonus recipients, and people who get sudden windfalls so often end up with nothing to show for it within a year or two. The money was never real to them in the first place. Studies tracking lottery winners have found something surprising. A large share of big winners report being back to their original financial situation within just a few years. Not because the amounts were small. Some of these windfalls were life-changing on paper, but on paper and in the bank are two very different things. The money arrived labeled as a gift, and gifts in the mind are meant to be enjoyed, not managed. Here's a small test. Think about how you'd feel spending $50 of your normal paycheck on something unnecessary. Now think about how you'd feel spending that same $50 from a refund you just got. For most people, the second one feels lighter, easier, almost free. But it isn't free. It's the exact same $50. Your bank account doesn't know where the money came from. Only your brain does. Now, here's what rich people do differently, and it's smaller than you think. Then they don't necessarily save all of it. Many of them don't even save most of it. What they do is pause just for a day, sometimes less. That pause is the entire trick. Psychologist Daniel Kahneman, who spent decades studying how people make decisions under uncertainty, found that most of our financial choices are made by what he called the fast system, quick, automatic, driven by emotion. The slow system, the one that actually calculates and weighs options, almost never gets a chance to operate because by the time it wakes up, the money is already spent. Kahneman spent years studying these two systems alongside economist Amos Tversky. Together, they found that people are often willing to make worse decisions just to avoid the discomfort of waiting or the discomfort of thinking too hard. Spending feels good immediately. Saving feels like nothing immediately. And nothing loses to good almost every time unless something interrupts the pattern. People who build wealth aren't smarter. They're not more disciplined in some moral sense. They've just built a habit of interrupting that fast system, even briefly. So what does that pause actually look like? With $1,000, it looks like this. The money arrives. And instead of opening a shopping app, they open a different question. What would future me want me to do with this? That's it. That's the whole shift. Sometimes the answer is still spend some of it. Rich people enjoy money too. This isn't about deprivation, but the pause changes the ratio. Instead of spending all $1,000 on something that disappears, they might spend $200 on something they'll enjoy and move $800 somewhere it can grow. Why does that matter so much? Because of something almost everyone has heard of, but almost nobody has actually felt. Compound interest. In plain English, compound interest is your money making money. And then that new money making more money too. It sounds small. It sounds boring. For the first few years, it basically is boring. But here's a simple way to see it. Imagine that $800 invested and earning a historical average stock market return of around 7% a year after inflation. After 10 years, it's roughly $1,575. You doubled it without doing anything else. After 20 years, it's around $3,100. After 30 years, it's close to $6,100. Same $800, zero additional effort, just time and the decision not to spend it the day it arrived. Now, stretch that out further. After 40 years, that same $800 grows to roughly $12,000. 40 years sounds far away. But so does the moment decades ago when someone you know now made a small decision that quietly became a much bigger one. This is the part nobody shows you because it's not exciting. There's no dramatic before and after, no flashy car, just a number quietly growing in the background of someone's life. Economist John Maynard Keynes once wrote about how people consistently undervalue future rewards in favor of present ones. Researchers later studied this directly, and it has a name: present bias. Present bias is why $200 of pure fun today feels like it matters more than $3,000 sitting in an account 20 years from now, even though mathematically that future $3,000 is the better deal by far. Economists have run experiments where people are offered a choice: a smaller amount of money today or a larger amount of money later. And over, people choose the smaller amount today, even when the later amount is clearly objectively bigger, not because they can't do the math, because the future version of them doesn't feel real yet. It feels like a stranger. And it's easier to be generous with a stranger's money than with your own right now in this moment. Your brain isn't broken for feeling this way. It's just old, older than money itself, actually. For most of human history, resources didn't keep. Food rotted, shelter could be lost overnight. Grabbing the benefit now was the safer bet. But money doesn't rot. Money, left alone in the right place, does the opposite. It grows. The problem is your brain hasn't caught up to that yet. So when rich people do something boring with extra money, they're not being boring by accident. They're working around a part of their own brain that's still wired for a world that doesn't exist anymore. There's another piece to this, and it's just as important as the math. Where you put that $800 matters less than most people think, at least at first. A basic low-cost index fund, a high-yield savings account, paying down a high-interest debt, which is mathematically the same as earning that interest rate on an investment. Any of these beats the alternative, which is the money simply evaporating into something you can't remember buying 6 months later. Economist Robert Shiller, who has spent decades studying market behavior, has pointed out that most people overestimate how complicated good financial decisions need to be. The hardest part usually isn't choosing the perfect option. The hardest part is choosing any reasonable option instead of choosing nothing at all. Nothing doesn't feel like a choice, but it is one, and it's usually the most expensive one. Researchers who study spending behavior have found something striking. When people are asked months later what they spent unexpected money on, a huge portion can't actually remember, not because the purchases were secret or shameful, just because they were forgettable. A few dinners out, some online orders, small leaks, one after another, until the $1,000 is gone and left behind. Nothing you could point to. Compare that to the version where even half of it goes somewhere that compounds. In 10 years, you might not remember the $200 you spent enjoying yourself, but the $400 that turned into roughly $780 is still there, quietly, whether you remember it or not. This is the real difference between people who build wealth and people who don't. It's almost never about income. There are people earning six figures who are broke. There are people earning much less who are quietly building real wealth. $20 and $50 and $100 at a time. The difference is what happens in the hours after money arrives, not the years after. The hours, it's the pause, the question. The small percentage that gets moved somewhere, it can grow before the rest of it gets the chance to disappear. So here's a thought experiment. The next time money shows up that you weren't expecting, even something small, try this. Don't decide anything for 24 hours. Just let it sit. Then ask the question, what would future you want you to do with this? You don't have to save all of it. You don't have to be perfect. Even moving 20% of it somewhere, it can grow while still enjoying the rest, changes the trajectory, not dramatically, not overnight, but 20 years from now, that small redirected amount could be worth 2, 3, sometimes 4 times what it started as, just from sitting still. So the next time an unexpected $1,000 lands in your count, remember this. It's not really about the $1,000. It's about the next 10 minutes and whether you let your brain decide or whether you let it pause first.